Hey guys, my name is Evan and welcome to Economics 101, your number one source for everything economics. So, mortgage rates exploded over the last few years, and millions of Americans blame the Federal Reserve. But here's the twist: the Fed doesn't directly set mortgage rates. The real driver is the 10-year Treasury yield. Today, we're going to break down why mortgage rates follow Treasury bonds, how inflation impacts both of those, and what could happen next in the housing market. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple economic breakdowns without the Wall Street jargon, please hit the like button and subscribe. Now let's go ahead and hop into the video. What is the 10-year Treasury? I'm going to briefly explain it so that everybody's on the same page. So the 10-year Treasury is basically the U.S. government bond, is a U.S. government bond that matures in 10 years. Investors typically buy it because it's considered one of the safest assets in the world. The yield, which is basically your interest rate, that changes constantly based on inflation expectations, economic growth, Fed policy, and investor demand. And this single number influences almost everything in finance, including mortgages. All right. Um, let's talk about why mortgage rates track it. All right. So most 30-year mortgage rates move closely with the 10-year Treasury yield. Why? The reason why most mortgage rates are so directly tied or connected to the 10-year Treasury yield is because mortgage backed securities compete with Treasury bonds for investor money. All right, I'm trying to simplify that. If investor yields rise, or if investor interest rates, if Treasury interest rates rise, mortgage investment demand higher returns also. Okay. Basically, if interest rates rise, investors want higher returns. That pushes mortgage rates higher. Historically, mortgage rates tend to sit roughly 1.5 to 3% above the 10-year Treasury yield. So when Treasury yields spike, home loans costs usually also follow that. Now, technically, the Fed controls short term interest rates, not mortgage rates directly, but the Fed still heavily influences bond markets. If inflation stays high, the Fed may keep rates elevated. Investor investor demand higher treasury yields. Mortgage rates remain expensive. That's exactly what happened after the inflation surge in recent years. Why this matters for housing so much? How housing higher mortgage rates crush affordability. Say that again. Higher mortgage rates, higher interest rates crush affordability. Think about it like this: a family that could afford a $500,000 home at 3% rates might only afford a much cheaper home at 7% rates. That slows sales, refinancing, construction, consumer spending. Housing is one of the most interest rate sensitive sectors in the economy. So any change in those interest rates is going to directly affect the housing market. And this means treasury yields affect far more than just Wall Street. Okay? Quick pause, guys. If you want more easy to understand breakdowns on housing, inflation, interest rates, and the economy, subscribe to Economics 101 and join the channel. Moving on, what happens next? Uh, if inflation continues cooling, treasury yields could eventually come down or could eventually decline. That may help mortgage rates fall also, but markets are watching out for inflation reports, jobs data, uh, Fed meetings, and as government debt levels. Because if investors fear inflation is going to stay around longer, bond yields may remain elevated longer than people expect. Also, and that means higher borrowing costs across the economy. All right. So the next time mortgage rates move, don't just watch the Fed. Okay, watch the 10-year treasury. That's what I want you to be able to get out of this video. Watch the 10-year treasury next time you see any interest rate moves. Okay, because that bond market may be the single biggest force shaping housing affordability in America today. If you like this video, please like, subscribe, and comment below. Would you buy a home at current mortgage rates? I think we're probably right at about that 6% mark right now. So drop a comment. Would would you be purchasing a property with the current mortgage rates? And remember, this is Economics 101, your number one source for everything econ. Thank you.